CNBC-TV18. A whole lot has happened since morning in terms of news flows, but nothing to show in terms of moves on the market itself. There has been a lot of point-to-point ups and downs on the index, but if you just woke up and saw the index from yesterday's close, it's moved all of 3 odd points. The mid-cap index is bearing the brunt of the weakness that we're seeing. 1,700 stocks declining for about 1,000 stocks which are advancing. The mid-cap index too has recovered a wee bit from the lows. The Nifty Bank also meanders just above the green line, facing some resistance around the 200-day moving average of 39,717. That's about the markets, but the biggest news came in from the North Block from Delhi, Sonal.
Oh, it did. And, you know, apart from the mutual fund industry impact or the debt mutual fund impact that we have been talking about, there are a whole host of amendments that have been proposed in the finance bill. And that is something that could impact industries across insurance sector. We're talking about mutual funds, the REIT industry as well. So let's do one thing. Let's summarize all of them and ask our experts to the big story. We'll put focus on the finance bill, proposed amendments that are there in the finance bill as well. We have with us Mr. Sudhir Kapadia, partner tax at EY India, and Kuldip Kumar, tax consultant and former national leader, global mobility practice at PwC. Joining us now to discuss this, of course, Mr. Kapadia will also be with us on air in just a bit. Mr. Kumar, let me come across to you first up. Well, there are a whole host of amendments which has really surprised the industry as well. But the first up and the biggest one is removal of this indexation benefit from debt mutual funds or international funds. What do you think is the rationale here?
Well, I think that the government probably wanted that, bring that product at par with the fixed deposit, because the banks are not getting the deposit. So I think that now these investment in such mutual funds will become at par with the fixed deposit. But I think the most important point we should not forget, if you will see for the last few years, what has been the government approach? They want to tax, the high net worth individuals. So whether it was taxing the, contribution to the provident fund exceeding 2.5 lakh or the other measure. So I think this was one of the way where the high net worth individuals were using that route to save some taxes, so that has been plugged.
Well, that has been plugged, but that's also caused some leakage in other sectors, and a big ones that we've seen all the, AMCs down in trade because one of their products has now been culled down upon. At the same time, all the non-banking financial companies as well, the NBFCs, Bajaj Twins, Bajaj Finance, Bajaj Finserv. We've seen a cut in Aditya Birla Capital as well, because these debt mutual funds were an important source of funds for these stocks as well, rather these companies as well. And now, there has been some tightening on the tap on that one. So Bajaj Finance at the low point of trade. Alongside that, we have Bajaj Finserv and Aditya Birla AMC as well. But Kuldip, I wanted your thoughts on the insurance industry. What does it mean for them? I mean, the street was hoping for some sort of relief coming in for them. No relief has come for them. At the same time, their exit route has also been cut, because a lot of people thought maybe, okay, I'll pull out my money from the insurance products and put it into debt funds. Now that doesn't happen either.
Well, I'll say that, first of all, all these amendments are applicable from 1st of April 2023. Yes. So it means that everything investment which anyone is holding or anyone making investment until 31st of March 2023 would be grandfathered. So now the insurance industry has a big, demand that, at least if not the exempting the full tax for the full realization from the insurance proceed on maturity, and so they should have been kept at par with the ULIP, for example. For example, if you're investing in ULIP and any policy which is more than 2.5 lakh, and the proceed from them is taxable as a capital gain. So they have not even afforded a capital gain tax treatment to the insurance policy where the premium would be more than 5 lakh, which are bought after 1st of April 2023. So I think, again, the silver lining is that government want that all the individual should pay the rightful taxes, and particularly the high net worth individual. And that is why, all those products you are seeing, whether it's the insurance product, whether it is the debt mutual fund where, some of these high net worth individuals were parking their funds. So they have, they want to tax it as a normal income and taxable at a normal applicable slab rate to them.
Okay. Kuldip, we'll just come back to you. We also have Mr. Kapadia from EY joining us to discuss this. Mr. Kapadia, it has actually come in as a surprise, right? The expectation was for the insurance industry. It's now the mutual fund industry that's bearing the brunt right now. Of course, we are talking about bringing everything at par. But since there are more corporates which invest in debt funds, what do you think it will mean for them? Because we spoke to Mr. Sheshagiri Rao earlier and they said now corporates will have to relook at routing their capital to mutual fund debt funds. How big of an impact could it be for the corporate India?
One is, I agree with you, it's a surprise because something which is as far-reaching should normally come in the normal budget proposals, not somewhat as an afterthought now. So clearly, there have been some triggers which has made the government bring it through these amendments. I'll just come to corporates, but before that, I don't know whether that has been discussed, but I was thinking about the target maturity funds, especially if you think about Bharat Bond, which were, rightly, marketed by government also to say that this is one way of deepening the debt markets for investors. Now, prospectively, if these changes were to be carried out, even investments in such target maturity funds, which are essentially for mobilization of debt for the public sector, will get adversely impacted. So I'm just wondering whether, as a policy measure, this is the right one when it comes to deepening the debt market for investors. Because that was the original objective behind, for example, Bharat bonds, as I said. And after that, a lot of the private sector mutual funds have come out with their own versions of passive index target maturity funds, which will get seriously impacted. So I think that's one impact which needs to be appreciated and understood better. Coming to your point on corporates or high net worth individuals, I must say that, as we know, the banking industry has been clamoring for this, on-par treatment for a long time, saying that their mobilization of deposits are getting impacted because of this slightly, different or unreal treatment of income earned from mutual funds. And that is what they have perhaps sought to bring it on par. We know corporates anyway park short-term funds even today in liquid or market instruments, which are taxable at normal rates. So I think from a corporate perspective, it would be tax neutral vis-a-vis short-term parking of funds with banks or liquid funds and the like.
You spoke about a couple of things there, Sudhir. One of them being that there are so many amendments outside of the budget as afterthoughts and not in the budget itself. We'll talk about that in just a bit. But the RBI norm itself, that if there is an exposure of a corporate for which that person requires, the corporate requires over 10,000 crores, 25% has to be from okay, we do have the finance minister speaking in the Lok Sabha. The finance bill has been tabled. We'll continue this discussion after we hear her.
I want to draw the honourable member's attention is representations have been received that the national pension system for government employees needs to be improved. I propose to set up a committee under the finance secretary to look into this issue of pensions and evolve an approach which addresses the needs of the employees while maintaining fiscal prudence to protect the common citizens. The approach will be designed for adoption by both central and state governments. Sir, there is one more thing. It has been represented that payments for foreign tours through credit cards are not being captured under the liberalized remittance scheme, the LRS. And such payments escape tax collection at source. The Reserve Bank is being requested to look into this with a view to bring credit card payments for foreign tours within the ambit of LRS and tax collection at source thereon. So there are many more things which I would like to talk, but I certainly don't want to take your more time. Thank you for giving me this opportunity.
विधेयक पर विचार किया जाए जो सदस्य
All right, some commentary coming in from the finance minister. Obviously, no clarification on this as it wasn't expected either, but you had something to say?
Yes, the important thing is where the finance minister said that earlier credit card payments for foreign tours were not considered under LRS, which is the remittance scheme. So the TCS this time around, tax collected at source, had been increased to 20% versus 5% earlier. So now if you're making a payment by credit card as well, this credit will be deducted. So that's something that she said. We still have our tax experts with us. Mr. Kapadia, if you could hear what the finance minister said, any comment on that?
Yeah, I think this was somewhat of a lacuna which was there in the LRS. And there was consciously a view taken that credit cards need not be subject to this TCS. This is also a very far-reaching proposal. I don't know how they will go about implementing it and tracking it, but this certainly makes spending money through credit cards or otherwise for foreign tours, etc., far more expensive. My only concern is that it should not unwittingly encourage a lot more cash to be deployed by those who can do it to avoid these kind of provisions. That's the only downside of this. But in principle, whether it's a credit card payment or a remittance from a bank, it should be covered, and I think that's what they are trying to cover it.
Okay.
All right. And all the other amendments that were made, apart from the big one that we've been talking about since morning, is there anything that really stands out for you? I see some with regards to the REITs, they get impacted, some benefits coming in on Gift City as well.
Yeah, those are of course they were the good ones on further making the IFSC more attractive. I think the one on royalty and fees for technical services, where a few years ago under the domestic law the withholding tax rate was reduced from 20 earlier to 10%. The reason being that many tax treaties have a lower rate of 10% on royalties and fees for technical services, and the idea was to make it really neutral between a tax treaty and domestic law. Now, this proposal to bring it back to 20% suggests two things. One is that where a taxpayer, which is a non-resident, is trying to get a lower rate under a tax treaty, I think it will increase scrutiny for the non-resident because of the fact that the entity will have to demonstrate bona fide tax residency in the treaty country to get a lower rate. Because sometimes the difference could be as high as 10%, 10% in treaty, 20% under domestic law. And I think secondly, we are, the point which I've been making even prior to the budget, we are really seeing an extreme expansion of the dragnet of tax deduction at source mechanism. It is just almost every payment is now getting subjected to TDS. And that is, I think, government's efforts to increase the tax base and ensure that all recipients of income are persuaded to file a tax return, and if not, to at least collect tax upfront from TDS. In fact, as high as 49 to 50% of tax collections now are coming in through withholding taxes, and this will only increase with some of these amendments which are proposed.
Mr. Kapadia, thank you for your views, but we are running out of time. So, Mr. Kumar, your comments, what stood out for you, if you can quickly tell us that?
I think this 20%, on the credit card, on the TCS, on this foreign LR scheme is very, very harsh. Now we see that many of the, students, for example, studying there, and to maintain them, if the parents are sending the money, so they have to shell out an additional 20% on that. So that is a little bit of, a little aggressive. I think that another important thing which has come, the marginal relief has been introduced for those who are having income, up to 7 lakh. So, this marginal relief used to get when there was a surcharge, or at that time it was applicable. So that has been extended to those incomes. So those who are earning little more than 7 lakh, and they will also get benefited from that proposal.
Okay, all right, gentlemen, thank you so much for joining us today and making sense of those numerous amendments that we've seen in the finance bill today. We'll touch base with you again to understand more of it, but that's the sum and substance for now. There have been many changes which are made in the finance bill, so just going over it and discussing and analyzing all of it for you. We'll slip into a short break now and continue to put focus on the proposed amendments in the finance bill, which is to do away with indexation benefits when it comes to debt mutual funds. Stay tuned for that.